Hello and welcome to another video on my YouTube channel. My name is Joris and today I think I am here with a rather important video about risk, because it seems like nobody is talking about the risk that you are taking when you are investing onto the stock market. And nowadays it seems like everybody is talking about taking high risk in growth stocks, and that is now the gold standard. And they forget to say with it that you are taking a higher risk with growth stocks than you are with the normal stocks. So it's all you hear about on the internet fora and even on YouTube. So the growth stocks are the way to go, and that the dividend stocks, although they proved their worth in the past, they are history. And why is this? Well, I think it is so that investors that started investing in the last 10-15 years on the stock market, they are also more visible on the internet. They are more active on internet fora. They are also more active on YouTube and stuff. So they are not looking at the stock market like people who saw the 80s and the 90s and the rush up to the dot-com bubble, which popped then in 2000, 2001. And if you look at those numbers, Black Monday down 22%, the Dow Jones took 2 years to recover from it. The dot-com bubble, yeah, almost lost 50%, the S&P 500. It took more than 7 years to recover from that, and a lot of firms that had high valuations at the time of the dot-com rise, they went bankrupt and they aren't even visible on the stock market anymore, because yeah, they aren't around anymore. Then you had the global financial crisis in 2008, 2009. A lot of investors saw that crash, of course. Even the ones that started investing 15 years ago, they can still probably remember before they started investing that there was a global financial crisis. But that crisis mainly affected the banks, and it dragged down the rest of the market a bit as well. But yeah, when you look at the S&P 500, minus 57%, so that's not nothing. But it was mainly the banks and stuff. So when you ignored the banks and later started investing into the stock market when it was down, yeah, you really lived the life as an investor, because since 2010 the market has only gone up considerably. Okay, you have the COVID crash of 2020, but it was only 5 months and the stock market was up again. Also, with the 2022 market decline, it was only 1 year that it took to recover from that. And yeah, people seem to forget that you can also have longer periods of recovery after a crash. So they think that investing with taking higher risks is the way to go. But I can't neglect the fact that I see a lot of similarities between the artificial intelligence boom right now and the internet boom that we saw in the 90s. A lot of people were then just like now explaining and trying to explain why the valuations that we saw for so many companies was justifiable. And even though the signs were up the wall, just like for Nvidia now, the first signs are there, the growth is starting to decline. It's still really high, and you hear it all the time on YouTube. Yeah, Nvidia, they okay, the growth declined, but the growth is still really high and they have a really high revenue. We haven't seen that before. I have seen that before, and that was in the dot-com bubble of 1999 and the other 90s. So that's why I can't invest into stocks that have a similarity to stocks that were around at the end of the 90s. What I look for is stability. So I look for an established track record. I look for a strong balance sheet. I look for a market leadership. I look for reputation and brand recognition. So customer loyalty, like for example Nestle. I haven't bought it yet, but normally I will buy it in the next month or the next 2 months. Hopefully at a lower price than what it is now. But yeah, I think it's really important that you have established companies that also provide a dividend, because dividends being paid out for multiple of years with a consistent rate of increases, even though it's not that high, for example, just above inflation rate, for me that's excellent. That proves how strong a company is and how long lasting it will be, and it will give less volatility as well, and that is what I'm looking for. So stability. What I try to avoid is taking higher risks. So then you have to look at companies with unproven business models that everybody thinks that are the future, although you yourself may think, hey, why are you thinking that this is the future? Maybe it's too disruptive and maybe it's too far-fetched. So only if I believe in it myself, I will start taking small positions in such stocks, but only in the companies that I think will actually survive. And also, if the business model is starting to prove its worth and you see the revenue coming, that's also important, because there are a lot of companies which actually don't make a profit and they actually have a high negative cash flow. And when you see that, you should run. On top of it, you can have companies that have a high stock-based compensation for their employers or even the owners of the company, which gives a high dilution for other stockholders. So if you see that, also try to shy away from those companies. And also, yeah, I think stocks with a high PE value most of the time also have a higher volatility. So like for example Nvidia, I'm not saying that they have an unproven business model, because that's not the case at all. I think they are way more cyclical than people are thinking right now that are investing into Nvidia, and that's why it's way overvalued with a PE of 55 around that, I think, right now. But with a high PE comes a high volatility, because something goes wrong and it can go really fast, with investors saying, okay, now I don't think it's worth a PE of 55 anymore, but now for me it drops to 25. Man, then the stock price goes down quite fast. So you have to really take that into considerations when you are investing in such a stock. You are really taking on high risks. So when you ask me to choose between investing into blue chips that have a track record and years of making a profit and distributing dividends, perhaps it's not yeah, it's not obliged that they also distribute the dividend. They can also just choose to reinvest their dividend. For me, it doesn't really make a difference. I'm a value investor that really likes dividends. I'm not a true only dividend investor. I like dividend ETFs. That's something else. But if you let me pick between a blue chip and a growth stock, I know what I will pick. When you ask younger investors, so people that are investing for less than 15 years, they tend to laugh with that choice. And for me, that's not a problem. I just want to warn them that what I've seen in the past can cost them a lot of money. And I've seen it with friends of mine, with family of mine, that it can cost a lot of money. And I didn't make the mistake when in the 1970s, 97, 98. I also invested into growth stocks. I made a lot of profit, but I thought that it was way too dangerous to keep investing into those, and I was actually trading a bit with the money that I earned for my vacation jobs, and I stopped with it in 1999, and that was the right decision, but at least I stopped at the right time. A lot of people that are starting to put their money into the stock market right now, yeah, I don't know how much longer it's going to continue, the AI bubble, but eventually it's going to pop. And when it pops, a lot of money is going to get lost. And yeah, this one is really important. So for me, it's not a problem that people say to me that I don't dare to take risks, and that they laugh with me for not daring to take risks, because I decide what I do with my money and they decide what they do with their money. And I'm happy with on average 8% annual return, because on a savings account right now I only receive 0.5%, so that's nothing. And having an annual compounded return of 8%, which means that every 10 years I double my money, I'm really happy. So I'm not complaining at all. And that is why I keep trying to buy good companies at cheap valuations. Do I make mistakes? For sure, I make mistakes. I buy a firm at low PE value, like Volkswagen, and I say, yeah, my target is 8. I buy it at 3.5. So I buy it really cheaply, but the problems of Volkswagen aren't over yet. So they report results, they are worse than expected, and the company keeps dropping in price because the earnings per share drops. The PE remains almost the same, so it's still around 3.4 right now. So PE wise, I'm not wrong, but the earnings per share drops further, so that's why it's cheaper right now. But I always stick to my numbers and to my investment theses. And for instance, I will talk about Meta. For me, Meta, it's a company that is not going to grow anymore in the future. Because for what I see, a lot of people around me, they are using it less and less and less. They are just using it to post messages and pictures. The impact, like, yeah, it used to have on the people when they were in their 20s, just beginning of their 30s, now Facebook has less impact. Okay, they noticed this too, and they put now a lot of money in artificial intelligence in the metaverse. They stopped with that more or less, but they are still putting um, a lot of money into developing their glasses. So the 3D goggles, they are more or less gone. Now they are putting them into the glasses, and maybe that can replace the smartphones in the future. But as I remember the fact, when I started to wear glasses in school, people were making fun of me with my glasses. So people don't want to wear glasses. Sunglasses, yes, but normal glasses, it's always a bit associated with being nerdy. Look at Superman. Superman without glasses, he is Superman. Superman with glasses on and normal clothes, yeah, then it's Clark Kent. So that's a big deal. The mindset may be different right now, but I don't believe that they are going to replace the smartphone like the smartphone impacted the fact that the normal cell phones were disrupted by the smartphone. So for me, that's a really big if. They are right in trying to do something, but I still think that Meta, even though they gained a lot of price action in the past year and a bit, I think that investing in Meta is a bad choice. And then you have the fact that when you start small, and me myself, and I think a lot of normal people that start investing, they start with one stock, or even better, one well-diversified ETF. So that's what I want to say on my YouTube channel. If you start investing and you want to build a good portfolio, pick a good diversified ETF and build up your portfolio with that one first. It's maybe a bit boring, and that's why I'm a big advocate of dividends, because then every quarter or every month you see dividends coming in, and seeing those dividends coming in, that keeps you motivated and keeps you going. And you build from there. So step for step, stock per stock. Okay, you have other people that have enough money, they can take more risk and they can immediately diversify into 20 growth stocks or even more. And as you know, taking on more risk can give higher returns. So I'm not saying that they are wrong that they want to invest into growth stocks. I just think they should point more to the fact that what they are doing is taking more risk as well. So, and they also, yeah, you need to be able to do it capital wise and mind wise. So, if you are a guy like me or a girl like me, and you are just starting out and you can only save a little bit, like 100, 200, 300 Swiss francs or euros per month, and you start investing, you can't immediately diversify into 20 growth stocks. Your costs will be enormous when you buy 20 different stocks with only 200 Swiss francs. So, and as I've said during this video, I also take a risk. So because I invest money, and if you want a higher return, so I want 8% return on my money, more or less. And if you want that, compared to a normal savings account, on a normal savings account, you take no risk. So investing into a company, it always comes with risk, but that also gives you a higher return. So for me, I try to avoid the riskier stocks with too high valuations, which seems to be unrealistic or unmaintainable in my eyes. Like for example, Nvidia, I think it's a great firm, but seeing the recent growth of the stock price and the high PE valuations, and seeing that although until 2 quarters ago the growth was still rising, the last quarter the growth of the revenue was starting to decline, and in relative numbers it's still growing, but compared to the previous how do you say it, the previous quarter, the growth rate is actually starting to decline. And I think the biggest firms will also start declining in their investment strategy, because their centers with AI chips are actually pretty much built. So, and you also have to, they have to see a return as well, because so far the return of their AI centers is actually really low, up to not existent. So yeah, people are going to start questioning why their firms are actually putting that much money towards artificial intelligence. And when that starts happening, they will dial down their investments, and this will weigh on the stock price of Nvidia enormously, because you have the double cutting sword of dropping earnings per shares and dropping PE ratios. And that can make that the price loss of a stock can be quite substantial in a very short period of time. And That's why I try to avoid companies with really high PE values. So I try to avoid growth stocks or what? Well, I guess, but not all of them. If I believe in one, I will buy them for sure, but only with a small starting position as a satellite. Right now, I have none. I can tell you that. I have no starting position in any growth stock concerning artificial intelligence or something like that. So I don't have ASML, I don't have TSMC, I don't have Nvidia, I don't have ADM or AMD. What is it? So I don't have those stocks at all because I think it's way too overpriced right now, that sector, and I don't want to take the risk. So, and when I can do that, it's only because I already am building the core satellite portfolio for longer. So I already have a strong core with all the ETFs portfolio. I had the ETFs in our ETF portfolio. That is the core. And the satellite portfolio is now the U portfolio. So I'm trying to, stick to that strategy. And the thing is, the risk is real. And when you invest with your savings, you don't want to risk losing it all. And so you can, yeah, if you only buy growth stocks, you have more risks of losing it all. So you always have to take it with a grain of salt because you are not taking no risks when you are investing in normal blue chips that are around for already more than 25, 30 years. Nvidia is also actually an old company, but they only picked up in the last 3, 4 years, in fact. So dividend aristocrats, they have a track record, and maybe 1 out of 20 will go bankrupt due to something that is going wrong. And when you invest into that one, when you start investing and you invest it into one stock, because you see the valuation going down and you see the PE value is good right now for that stock, and you overlook the fact that in fact something is absolutely going wrong with the firm. So you think it's less important than it actually is. You buy that one firm, then you are screwed when you only buy that one firm. But that's then your first buy of the first month. The second month you buy another firm. The third month you buy another firm. And by the time that the first firm that actually goes bankrupt is bankrupt, there is a long time period going by, and you can also sell the firm with a loss. You can't forget about that. You can always sell and take a loss. As long as you don't sell, you don't have a loss. Example for the Volkswagen shares that I have in the U portfolio. I'm on a big loss right now, 18% right now, but it's not an actual loss until I've sold. If it keeps going the wrong way, I will sell and I will take the loss for sure. I'm not sticking around until it reaches zero. That's for sure. But growth stocks, they are a bigger risk because they have a fail rate of around 90 to 95%. So if you have 10 growth stocks, it can be that they all fail, and then you are left with nothing. If you can buy 20, so yeah, you can take more risk, for example, and buy every month for a period of 20 months, you can buy 20 different growth stocks. That's even more risky than when in the beginning of the that 20-month period you have the money already to immediately diversify into the 20. But when you are just starting out, you don't have the choice, of course. But if you have 20 stocks, 20 growth stocks, and only one or two succeed, you will have success because it will be a firm that goes times 100, times 200, and you will have a lot of profit. But you will also have 18, 19 firms that go bust. A lot of people don't talk about that. They only mention the one that is gaining them a lot of success, and they don't talk about the rest. You have, of course, other people on the YouTube, luckily, that also show the losses that they make. I'm one of them, so when I will make a loss, you will see it immediately. But for me, it's also about the peace of mind. So I invest into decent blue chip stocks that deliver me a dividend, and later on when I retire, I hope that they keep on doing it and I will sleep with a good peace of mind. But people that start investing into growth stocks, they should know that they are taking on a lot of risks, and if they can't live with the fact that one of those stocks goes down considerably in 1-2 weeks, then they shouldn't do it and rethink their strategy. And with that being said, I thank you for watching this video. Please consider subscribing to my YouTube video. Hitting that like button helps out the channel enormously as well, because then the YouTube algorithm helps distributing this video to other people that like this kind of content as well. And with that being said, thank you for watching to this one and see you on the next one on my YouTube channel. Bye!